Hey, y'all. You're listening to Winning at Life, live financial news talk radio. You know, winning. Yeah, it's getting ahead with your money, having something to show end of the month, end of the year, end of 30 years. Are you getting ahead? Well, you know, it seems to be a little bit harder nowadays. Hey, if you want to join the conversation, I am your host, Gregory Ricks, a financial advisor, money manager, founder, CEO, Gregory Ricks and Associates, a total wealth authority. Gosh, been in the industry advising probably, 30 years, plus a few. So been around the block a few times. You know, it is about getting ahead. And with inflation, I was reading something this morning, it cracked me up, said, and it's like, I have to pull it up. Let me see on my news feed, you know, on the smartphones. I tell you what, man, realize if I could have had something feeding me information all day long, every day, and making it convenient to read. Books have been around forever, but this digital stuff makes stuff so easy, and the videos, and hey, I wouldn't have had to travel all over the country for past couple decades to learn everything I know. And probably could have done it for less and no more, but it is pretty neat what we get to do. Okay, enough of that. Back to what I stumbled upon. Well, I was reading about Stephanie Pomboy had kind of mentioned that retail sales were up, but her comment was, well, yeah, but it's because prices have gone up. She said that should be considered in there as well. And then I was reading something else. I can't find it, but here's what they were saying. If you want to stop inflation, stop the buying. And then it was something to the effect, join the movement. I told Stacy, my wife, and I said, okay, got to stop the buying. If you got receipts and stuff still in boxes, stuff comes in every day. I said, start returning it. We can put a stop to this inflation, because if you relax demand, imagine, COVID was part of creating this, because lockdown, manufacturing stopped, and it was depending, was probably anywhere from 60 days to 180 days. I'm not so sure. But imagine if we all stopped buying something for 90 days. Inventories could catch up. Think about it. Don't buy any cars for a few months. If you want the car, wait. There'll be more in a few months. They'll catch up. I don't know if that'd work, but that was a novel idea there as far as stop the buying. Okay. I don't know if that would work, but I don't know. I can't help myself when I need something or want something. I get it. And I actually have targeted, because they always say I'm hard to buy for it. And I went to the mall the other day to get my booster shot, because it was I was told it's real convenient, no waiting and so forth. So I went and got my booster, and I'm like, and Stacy was with me. We both did it. And she said, why are you parking over here? I said, did you not notice the whole other side is full? There is no place to park. I said, if I've got a hike, I'm going to walk inside the mall, not outside. And when we got to for the vaccine shots, there was no waiting. But stores are busy. It's like the holidays. You know why? Holidays are early this year. People are worried about everybody running out. Macy's said, hey, we're good. We've got inventories. We prepared for this. We've got what you need for the holiday season. And then next year, we're going to close 10 more stores. So that's kind of the Macy's news today. Isn't that what you saw, James?
I did.
I know you're about to fall out of your chair.
Merry Christmas. Enjoy while you can.
Let's take a caller.
Oh, look, Spencer in New Orleans.
Hey, he called us at 504-260-0995 to join the conversation.
All right.
Hey, Spencer.
Hey, how are you?
Hey, we're doing good. How can I help you?
So I'm a little different from everybody else that calls. I'm 27, and I'm just trying to figure out a good long-term plan for retirement. Try to retire a little early, in late 50s. I just want to kind of a blueprint of maybe what I need to do to get there.
Well, one of the magic things. Oh, yeah. Here's something I was going to talk about tonight. 3 best ways to invest for retirement. You know what the number one is? Start investing for retirement early. If you're 27, I'll call that early. You could have done it earlier, but this is pretty darn early. Right. There. So I think that's one of the first things right there is to get started. And what you want is compounding growth. And in the second rule, Charlie Munger, Warren Buffett's buddy, says, do not let compounding be interrupted. Allow that to keep going. So that's kind of the first core things. You start early and keep it compounding. Now, go back to a core rule. Do you have emergency money? Because if you don't, and you're throwing all investments, you risk it being interrupted by needing money.
Yeah, I do. I mean, I have a good bit, of emergency money, cash on hand. And I feel like I'm just now getting to a position where I do have a little cash on hand for a rainy day. And I'm kind of looking towards the future. I'm putting 5% in my 401k right now, and I've been trying to research and look at all kind of stuff, and I didn't know what's the best way. I'm looking at index funds. I'm looking at I don't know all kind. I'm new at this.
Yeah.
I'm looking at all kind of different things.
So you've got a 401k you're participating in. You're putting in 5%. They're matching it, right?
Correct.
Okay. Well, right there, that's awesome right there. And that's kind of one of the traditional ways, is that's pre-tax money you're putting away. It's like Uncle Sam's helping you, your employer's helping you, that's like 50% of what you're needing to do right there. That's kind of magic where everybody you got to do the Roth, save the Roth. I think Roth is great.
Right.
But if this makes it easy, putting away pre-tax, getting the matching out there, I don't think ultimately having taxable income 40 years from now or whatever your target date is a bad thing. I think you should have some of this money going and then later maybe have access that, okay, I've got some more to put somewhere. Okay, then start doing some more to the Roth, because that's after tax dollars that becomes tax-free. Ultimately, I think we need all the tax worlds. Okay, you're 27. So one of the things to think about is, let me ask you a question, and this is for the listeners. There's no wrong answer here. Can you beat the market?
Probably not.
Probably not. I probably can't either. And that's not a bad thing. If you can't beat them, join them. So and I can tell you, want to know, one of my favorite strategies involves indexes. So you want to know how we've done the past 20 years? Well, look how the S&P 500 has done the past 20 years. How is the Dow? How's the NASDAQ? Done pretty good. Not every year is up, but I wouldn't put all my money there. But when you're looking and have a long horizon, when you look at 20-year rolling periods, meaning if you look at your return this year, you're looking back 20 years. You're not looking at the past year or past 5 or 10, looking at the past 20 years. Next year, when you look at it, you look back 20 years. Now, you can't do that with your money, but the point is, if you have a 20-year time horizon, so far, 20-year rolling periods, we beat them all. We are up 100% of the time. So I think the indices are way to go for a young fella like you. I'd be careful with 100% of it there. I like, you should have some short-term bonds in the mix, maybe not stay fully invested. There might be some opportunities in the future because the market pulls back. They give us that 10% pullback about every 1.84 years. So those are like buying opportunities for somebody like you that's taking a long view, and just put money away every month and you're going to be fine. Any other questions?
Okay. No, I think that's it.
Okay.
You kind of steered me in the right direction.
Okay. I hope so. If you have some more questions, give us a holler back. We're over here.
All right.
All right. Thanks,
Thank
Spencer.
Thank you, Spencer.
You know, he says he's not a normal caller, but we get a lot of those. And that's a lot of the listeners. They may not call it like, what do I do? Well, make sure you have some emergency savings. You know, the kind of rule is 6-month expenses, but that also ties to what's the outlook of your job. You need to have several months. And sometimes I'll give a bigger number. I think you're a retiree. It'd be cool to have $50K in emergency savings. Does that fit for everybody? No. Some people will fall out the chair. So one couple years ago, I said, you know, based on your situation, you ought to have $100,000 in emergency savings. You know, high net worth people. And I think I had to get up and help the lady get back in the chair. She like fell out. That was a big number, but it wasn't unreasonable. But it also is to adjust the thinking versus, we don't need any. Well, you may end up having to hit your investments, and what you don't want to do is disrupt that compounding effect, because you need that money moving up. To further add, what do I like? I like multiple asset classes. I like indexes through exchange traded funds. I like bonds through exchange traded funds. I like index linked growth. I use an insurance company. Some people know those as fixed indexed annuities. Why? I want participation rates. I want to get a portion of the upside of the market, and guess what? And not have downside exposure. That's my third asset class. The other is tactical. I want some of my money following momentum. I like old Mo. I like to go where Mo is going. Some of the money should go there.
504-260-0995. We are Winning at Life with Gregory Ricks.
As we work our way through this historic pandemic, now is a good time to reassess how you've been investing. Hi, I'm Gregory Ricks. That's what I do. Gregory Ricks and Associates Wealth Advisors with offices in Metairie, Mandeville, Gulfport, and Baton Rouge. Let's talk. 504-832-9200, GregoryRicks.com.
Investing involves risk, including the potential loss of principal. Investment advisory services offered through AE Wealth Management, LLC.
What's cooking, Gumbo Nation? Cash is king. You hear this almost weekly on Mortgage Gumbo. In 30 years of mortgage advising, it's never been easier to purchase or refinance. And with rates now hanging back near all-time lows, don't miss an opportunity to get those home projects done with a low-rate refinance or purchase that first or new home with zero to low down payment option. Visit snapsendandsave.com. It's that easy.
If you like money, you'll love the Winning at Life app. On the Winning at Life app, you can hear the Ask Gregory podcast, where you'll find episodes based on a financial topic. So if you're looking for help on a specific situation, there's a good chance you'll find it on the Ask Gregory podcast, including episodes on 401ks, taxes, stocks, Social Security, gold, and whether or not you should buy an RV. Hear the Ask Gregory podcast on the Winning at Life app, your wallet's favorite app.
Half of estate planning is having a plan put together for your loved ones when you pass away. The other half of estate planning is dealing with someone else's plan when they pass away. Sometimes they have a great plan, but sometimes you need a little help. Don't leave your loved ones in a bind. Call me, and we'll make sure you have a plan. Hi, I'm Wes Blanchard, an estate planning attorney in Metairie. What's your plan? Find me at wjblanchardlaw.com.
The Ricks Report with Gregory Ricks.
At the core, I always tell people, I'm not here to make you rich. I'm here to make sure you don't run out of money, that you don't run out of income. That's how I look at my job. Over time, saving, making good decisions can make you rich. But what you have is, what is your core thing? Your core thing should be making money. And your core thing, you should set aside money to work elsewhere. It doesn't necessarily mean you have to put it to risk. You could put it to safety. But your core thing makes you money, or you tell me your core thing is the market, day trading, or gambling in the market. It shouldn't be. You should have a core thing that makes you money, and you peel some off for the future when you're done with your core.
Winning at Life with Gregory Ricks. Find us on the Winning at Life app or winningatlife.com. Investment advisory services offered through AE Wealth Management, LLC. Investing involves risk, including the potential loss of principal.
'Cause you make me wanna pull this truck to the side of the road. Slide on over, let me hold you close and tell you everything I'm thinking.
Hey, y'all.
Hop on out with the tailgate.
504-260-0995. Hey, I broke some news last night on the show. It was the last segment. I'm going to go ahead and do it at this point. I do a Saturday show from 10 to 1. I've been doing the show for over 11 and a half years at this point, thereabouts. We started 11 plus years ago with a 9 a.m. show. It evolved to move to 10, then over years expanded. About 6 years ago, we picked up the weeknight show, which is this show we've been doing. Honestly, it's for years have made for long days, and then kind of forgot what it was like to be done at 5 o'clock, like the rest of you out there. Maybe not all of you, because some of you may be at work listening to the show, and then got to experience that again recently. And so it does make for long days. My day ends after 8 o'clock when the show goes off the air. So a few months back, I made a determination, and I actually had told a few on my team a year ago. I said, I think I've got maybe 5 years left in me for 6 days a week doing a show. And it turns out I was wrong. I don't have 5 years left in me. I determined, I've said, I think maybe I've got a year left. And then a few months ago, we talked to the powers that be and asked for a release from my duties on the weeknight show. So I was granted that after some pushing and pulling and so forth. And I said, hey, we're going to keep doing the Saturday show from 10 to 1. I just, I think I'm good on the weeknight show. I kind of need a break. For how long? Well, kind of from now on. So just wanted to share with you all the listeners, and I feel your pain, and I hate this because we have so many people call and ask questions, and this is a part of their day as well. But we're going to continue to be here on Saturdays for you from 10 to 1. Same stations. You can still get to us through the Winning at Life app. I've got the Ask Gregory podcast, but December 24th is the last day of the weeknight show. So appreciate your understanding, and just adjust to follow us more on Saturday. We have a tremendous audience. We have guests on the show, like this Saturday show. We're going to have Wes Blanchard, a state planning attorney, guest with me in the first hour at 10, and then Dwayne Stein in the second hour. Talk about mortgages, interest rates, and I want to get his thoughts on Zillow, what they've been up to. I think he's a little passionate about his opinion on that. So it's going to be a really fun show, and I appreciate your understanding. When we were talking, who was our earlier caller?
Spencer.
Spencer. I was going to call him Steven, but I'm glad you helped me out on that. Spencer. So he was basically called about what's the best ways to save for retirement. And one, early start, the better, because the longer the money can compound, the more you're going to end up with. Traditional tax deferred savings is okay. Your employer deducts the amount automatically from your paycheck, making it convenient to save for retirement. You can also have funds taken out pre-tax, meaning you get immediate tax savings. Employers can match within certain limits. So, for instance, they could decide to fund 50% of what you contribute up to 60%. So when you that's like a helping hand. Then your investments grow tax deferred, meaning you don't pay taxes until you withdraw the funds. That burden's taken away from you. So that's number two. And what I shared with Spencer is keep the compounding going. Don't let it interrupt. That's why to have emergency funds there. And don't do this timing. You can adjust a portfolio, rebalance, but especially when you're young like that, don't exit. Keep the compounding going. And then the other, no taxes later. Well, traditional retirement plans offer immediate tax savings. That Roth 401k or Roth IRA outside of your 401k, depending on income limits, you can contribute $6,000 up to $6,000 a year to that. You have $1,000 catch up if you're age 50 or over. We don't know what tax rates are going to be in the future, but they're probably going to be higher, especially if you're fortunate to save a lot of money. You know, one of the things I share with people is the impact of taking income. And one of the stories I talk about is if you start with $1 million, say in 2000, taking income, you have $1 million, say, okay, I'm going to put it in S&P 500. I'll even let you pick it. And let's say you pick Vanguard's S&P 500 fund. That would be VFINX as their symbol there. Oh, if I said that again, does that sound helping? VFINX. Okay, well, that's neat. Okay, so going on with the numbers, $1 million, and you're going to take $40,000 a year and increase it by 3% a year. So it's going to adjust upward 3% each year. So you've started with $1 million. At the end of 2021, so that carries us 21 years, your 40,000 that's growing at 3% a year on distributions in year 21 is $72,244. Yeah. Okay, so we've let it ride the market. The balance in your account is $314,220. Whew. That didn't go too well, especially what if you got another 15 years to live, you're going to live to 95. Yeah, you could run out of money. And get that. The market, you're taking out 4% compounding, but what did the S&P average over that time period? 8.07%. So how did that go for you? Well, let's try this instead. I just want to give you the different asset classes we kind of talk about. What if we did this with bonds? And we're going to use, say, the Vanguard's Total Bond Market Index Fund, VBMFX. Same thing, 40,000, inflate it at 3%, start with $1 million. In that bond index, at the end of 21 years, you have $1,037,841. Bonds compared to the stock market. Oh, what did the bonds average? 4.99%. Yeah, a lot less than what the market averaged. But you know what the bonds didn't have to do? Make up losses. Like in year 2000, the market was off 9. Year 2001, off 12%. 2002, off 22%. sequence of returns. You got hit real hard right out the gate. It could happen. I just gave you an example why all your money shouldn't be in stocks. If we used index-linked investing, fixed index, say with a 50% par rate on the S&P 500, that example would give you $1,065,873 at the end of 21 years. Same million in, same 40,000 inflated at 3%. Yeah, $1,065,000. Oh, what was the return? 6.05%. How did that happen? Well, they didn't ever have a negative year that they had to make up losses. Yeah, bonds had a couple. The worst year was minus 2.26% back in 2013. So once again, I believe a better way to invest is diversify, but also diversify asset classes. It gives you a smoother ride and would actually smooth it and increase the probability of success if some of that risk money was tactical, where it would follow momentum and adjust to one of those events that you don't see coming, like the Great Recession, COVID, lockdowns. That would help as well. So that's that distribution phase. That's that phase of coming off of Mount Everest, why you need a Sherpa, you need a guide, and you need to be careful, because the easy part is the growing the money, I think. The harder part is the distribution phase.
All right, give them an update on what's happening December 1st and December 2nd. What's this about? Who needs to go?
I think everyone. It is client-oriented because we're talking about some of our new tax-efficient, tax-free models we've added. We've got a new portal over at GregoryRicks.com, and there's a tab up in the right-hand corner. The new GPS is what I believe it's called, because we have the old one still up there, but it ends here in about a week and a half. The old portal goes away because the new one is so much better there. And in that event, we're sharing our improved tactical strategies, that asset class, and how it works better with the overall asset classes that we utilize.
All right, sign up for one of the pop-up events. Figure out which one fits in your schedule better. Go to GregoryRicks.com. There's an events tab at the top. If you have a question for the show right now, 504-260-0995. I'm James Parker. We're Winning at Life with Gregory Ricks.
Hey, James Parker here from Winning at Life. Something that's come up on the show over the last 10 years is that if you're not at your old job, maybe your 401k shouldn't be either. But do you really know why we say that? It's a funny thing. We put a few $100 in our 401k every month. It ends up to be thousands of dollars every year, hundreds of thousands of dollars over our career, and you don't really know that much about it. How do you invest it? How do you diversify? What do you buy? What do you avoid? You've got a financial situation and you're not quite sure what to do? Ask Gregory. Ask Gregory is our new podcast with these financial topics broken down into specific little chunks. So if you have a financial situation or you just want to learn more about money, ask Gregory. Find the Ask Gregory podcast on the Winning at Life app, the iHeartRadio app, Google Podcasts, Apple Podcasts, and Spotify.
And I want to thank you for all of your help.
That's exactly what I needed to know.
Investment advisory services offered through AE Wealth Management, LLC.
2 questions. Do you have a pulse? Do you own anything? If you said yes to both, you probably need a will. You may even need a trust. We all know a lawyer. Do you know someone who specializes in estate planning? Do you really trust the husband of your sister's friend from college? Or would you feel better putting your family in the hands of the estate planning attorney of the Total Wealth Authority? I'm Wes Blanchard. What's your plan? Offices in Metairie and at wjblanchardlaw.com.
If you like money, you'll love the Winning at Life app. On the Winning at Life app, you can listen to the show live 6 days a week. And if we're not on at the moment, you can hear a replay of the latest episode of Winning at Life. Whether you're getting a late start on your retirement savings or keeping up with the financial news, Winning at Life with Gregory Ricks is there on demand. Hear the Winning at Life show on the Winning at Life app. your wallet's favorite app.
Most people think of Crime Stoppers as only a tip reporting line, but we're so much more. Crime Stoppers GNO has worked in our area schools, offering prevention presentations on trending topics from drugs, bullying, online safety, suicide prevention, and much more. And we have a high school teen leadership program which provides students with a first-hand look at the criminal justice profession as a future career, while learning to be an advocate for their fellow students. So to learn more, visit safeschoolsla.com or call 504-837-8477.
Fox News, I'm Steve Rappaport. A high-profile death row inmate in Oklahoma is spared with less than a day to live.
Over the last few years, millions have signed a petition asking Oklahoma Governor Kevin Stitt to do what he did just hours before Julius Jones was scheduled to be executed. Now with the governor's clemency, Jones will be sentenced to life without the possibility of parole. Jones was convicted of murdering Paul Howell during a carjacking more than 20 years ago.
Fox's Jessica Rosenthal. President Biden says he's considering a diplomatic boycott of the Winter Olympics in Beijing. White House Press Secretary Jen Psaki.
There are areas that we do have concerns. Human rights abuses, you've seen not just in words we've used, but certainly in actions we've taken at the G7 and other sanctions, that we have serious concerns about the human rights abuses we've seen.
The boycott would not apply to Americans competing in the Games. America is listening to Fox News.
Winning at Life with Gregory Ricks is a copyright of Down South Strategies for the private use of our audience. Any unauthorized use of this broadcast without express consent is prohibited. For podcasts, show information, and contacts to our sponsors, go to winningatlife.com or download the Winning at Life app. If you've got a financial situation and you're not quite sure what to do, you better call Gregory. We are Winning at Life with Gregory Ricks.
Hey, y'all. Winning at Life. Live Financial News Talk Radio. If you'd like to join the conversation, get a little bit of help, not sure what to do, maybe it's that 401k, Social Security. That's, over the 11 years, that's been the number one topic. Before I go, I'll give you a thought on Social Security here in a moment. When I was talking with those numbers on the asset class, especially when we talked about the S&P 500 over the past 21 years, $1 million with a 40% and 40,000 inflated income would be down to 314,000 at the end of 21 years, starting at the year 2000 going through 2020. And that's taking a 4% stream. I've got an article here, Wall Street Journal. Experts say the 4% rule, a popular retirement income strategy, is outdated. Well, I showed you how it isn't, unless you're going to just do it all in stocks. Withdrawing money from one's nest egg is among the most complex exercises for households. It's kind of like Mount Everest. Should you go that alone? I don't think you should go this alone. There are many unknowns. The length of retirement, one's spending needs, health costs, and investment returns. That's just some of your complications. The 4% rule is meant to yield a consistent stream of annual income and give seniors a high degree of comfort that their funds will last over a 30-year period. You know what messed that up? It's called volatility. You see, market conditions, lower projected returns for stocks and bonds don't seem to be working in retirees' favor. And I think bonds have been really a great tool, as I gave you in that example, the past 20 years, 30 years. We had 2 negative periods on that bond index I gave you out of the past 21 years. The worst was minus 2.26. 2013. How do I think that's going to go forward the next 20 years? I think we're going to have more negative years. Depending if you have long duration, you can have a larger negative number, hence why tactical strategy should be in the mix. I know that's a generalization, but if you want to know more about how we do ours, one of those things. You can call my office at 504-832-9200 and start a phone conversation or come in and say, hey, I want to see how this Invest 50/50 works. I need a higher probability of success. That's what we'll show you how to do. So given market expectations, that 4% rule may no longer be feasible. And I kind of showed you why. Morningstar these days said the 4% rule should really be, here it is, 3.3% from Morningstar. Though the reduction may sound small, it can give a big impact on retiree standard of living. For example, using the 4% rule with $1 million, you're getting $40,000 out. But the 3.3%, you just whacked your income down to $33,000. The difference would be more pronounced later in retirement when accounting for inflation. The $75,399 versus $62,205 respectively in the 30th year, according to CNBC analysis. The analysis is using a more conservative rate of inflation than I did. They're using 2.21%. Looking at the 2010s, you would say that's high. Inflation in the 2010s was 1.8%. Well, inflation this year is over 7%. So why the 3.3%? This dynamic has perhaps lulled near retirees into a false sense of security. Bonds are highly unlikely to enjoy strong gains over the next 30 years, and high stock prices are likely to fall as they revert to the average, according to the report. So this nice run you've had the past 10 years, it may not replay itself. The analysis concedes that this result is likely, though not inevitable. While inflation has been historically high in recent months, Morningstar expects it to moderate over the long term. If you've been listening to Winning at Life, my thoughts on that is, I gave you some historical there. This does not keep going. I think, what's that number? Over the past 170 years, we've had 20 periods of 7% plus inflation. So investment returns are especially important in the early years of retirement due to so-called sequence of return risk. Taking too large a withdrawal from one's nest egg in the first year or years, especially from a portfolio that's declining, like 21 years ago, can increase the risk of running out of money lately. And that's because there's less runway for the portfolio to grow back. You don't have enough runway there to take off.
Hey, Walter, you're on Winning at Life with Gregory Ricks. How can we help you, sir?
Good morning, gentlemen. Enjoy the show.
Awesome. Thanks.
Question on the Social Security. I'm 60. My wife is 62. 61. Next year, she'll be eligible for Social Security. She has not worked. She's been able, I work, and she's been able to stay home and play grandma for the past 10 years or so. So we're thinking about turning on her Social Security when she turns 62 in order to help pay down debt before I hopefully retire around 65. So I guess, is that my question is that sounds feasible, or should we wait on hers, or?
Who is going to have the largest Social Security benefit between you two?
I am.
Okay. And is she's turning hers on based on her work record, right?
Correct. Yes, sir.
Does she have 35 years in?
Yes, sir.
Okay. Well, she's taking a pretty good haircut on that. That's not going to be made up in the future.
Yeah, I figured that. But however, whenever I turned my on, then she would be able to file off of mine. Correct?
Well, if it's a larger, if 50% of your benefit based on your FRA, which is going to be 67, if that's a larger benefit, but it still receives that haircut doesn't go away just because you're turning it on. She's locking in that reduction even when she switches to yours. Were you aware of that? So
yeah, I knew that it would be lower than what was expected, but I would think that it would still be I'm going based off of the Social Security website. When if you put on out down at the bottom what her expected would be when I turned mine on, it's definitely an increase in what she would be making based off of her work.
Okay, let me do some math real quick here, just to make this simple to understand. Let's say her, and I'm going to use everything based on age 67. Let's say your benefit's going to be $2,000 a month at 67. And her benefit at 67, let's make it simple, is going to be $800 a month if she waited till then. But you would have to turn yours on for her to get that record as well to that increase. So assuming everything being equal, hers is 800 and yours is 2,000. So 50% of yours would be $1,000. So yes,
correct,
that would be a larger benefit, and it will increase her benefit by $200 if we were all waiting till then. But she's going to turn hers on at 62, and that $800 is going to be reduced. When she switches to that 1,000 benefit, it's going to be reduced by the same percentage that the 800 was. So you will get some increase. It's not going to be a lot.
Yeah. Okay.
In that case, but that haircut goes forward to when she switches to your benefit if it's going to be a larger benefit. I don't have a problem with turning it on long as you understand how it works going forward. You've got the largest benefit, and we really need that benefit to go to FRA. And for all listeners, just understanding kind of conceptually how this goes. So if she turns it on at 62 or her FRA at 67, by age 80, no matter which one she turns on, she's going to basically have withdrawn the same amount over that period, because the 67 is larger than the 62, but the 62's coming out for 5 years earlier. So she does receive that money. It's just living beyond age 80, assuming she's in good health. You both make it to 65. She's living to 90-something. You're living to late 80s. And she's going, when you pass, she's going to draw the larger check. But beyond age 80, if you waited to FRA, you're receiving more money thereafter, or even deferred to 70 than you would have at age 62. 62, you're locking it in. But I don't have a problem with the smaller account turning on earlier, because it does help. And that's where ultimately the decision is, where rubber meets the road, is kind of what I always like to say. That's the difference makers. If you need that money to make things work long time, then that's the right decision.
We're Winning at Life with Gregory Ricks. If you've got a financial situation and you're not quite sure what to do, you better call Gregory.
You can email me, info@gregoryricks.com. If you're seeking some help, you're listening to this show and kind of like, I want to know more about the Invest 50/50. I want to know more. Come into the office. We've got one in Metairie, Mandeville, Gulfport, and Baton Rouge. So one number to call, and you could be in Alabama, Texas, Florida, and we have a huge audience in the southeast of the U.S., and we can do business online through Zoom. We got FedEx, Zoom, e-documents, all that kind of stuff going on.
Gregory Ricks and Associates. Find us at GregoryRicks.com or call 504-832-9200. Investing involves risk, including the potential loss of principal. Investment advisory services offered through AE Wealth Management, LLC.
When I was growing up, my mom relied on old wives' tales to get rid of outdoor bugs. One method included putting 2 pennies in a bag of water and hanging them throughout the backyard. And let's not forget Mom's go-to, the citronella candle, which never worked. It's the 20s. We have science and much more thorough ways to get rid of bugs. Call Mosquito Joe. Mosquito Joe has this time-release capsule that they spray that slowly releases their mosquito death over a course of a month. Because mosquitoes suck. NewOrleans.mosquitojoe.com.
Ask Gregory is a financial podcast from the guys who bring you Winning at Life with Gregory Ricks.
I'm your host, Gregory Ricks, a financial advisor here to answer your questions and help you win with your money.
Find the Ask Gregory podcast on the Winning at Life app, the iHeartRadio app, Google Podcasts, Apple Podcasts, and Spotify.
That's exactly what I needed to know. Simple information from good people.
Investment advisory services offered through AE Wealth Management, LLC. The Ricks Report with Gregory Ricks.
My age that I can claim Social Security is 66. If I wait to 67, I'll get an additional 8%. But you have to wait the full year. Do they prorate it like if you do it at 66 and a half, do you get 4%?
You get a credit for each month you defer. And here's a little technicality. Delayed retirement credits don't get calculated and applied till the beginning of the next calendar year. So if you're deferring and getting delayed retirement credits and then you turn it on middle of another year, those delayed credits will be factored in the beginning of next year and made up for what you didn't have and paid at that higher rate at the next calendar year.
Winning at Life with Gregory Ricks. Find us on the Winning at Life app or winningatlife.com. Investment advisory services offered through AE Wealth Management, LLC.
And a little bit of chicken fried. Cold beer on a Friday night. A pair of jeans
Hey, y'all.
just right.
By the way, tomorrow is Friday. One of my favorite tunes there. Hey, how about 3 Social Security surprises? Hey, if you want to join the conversation, 504-260-0995. If you're having one of those situations where the job's ending or did end, or you're thinking about it ending for whatever reason, maybe you just want to go in the gig world, and you've got money at the old job, go to gregoryricks.com/401k. Give you 5 good ideas of what you can do with that money at the soon-to-be old job or that old job you worked at. gregoryricks.com/401k. Social Security, 3 surprises that aren't pleasant. How about this? Benefits have a limited buying power. Yeah, many people assume their Social Security benefits will replace their previous paychecks. If you're an average earner, you can expect your benefits to replace about 40% of your pre-retirement income. Number 2, benefits are subject to taxes. Social Security won't come close to replacing your former paycheck. Well, here's some more bad news. You may not get to keep all of your benefits in full. If you're a moderate earner, you could lose a chunk of that income to federal taxes. And there's 13 states out there that tax Social Security. So if you retire in one of those, you might even lose more money. And then number 3, benefits can be withheld if you work and earn too much. In 2022, you can earn up to $19,560 without that income impacting your benefits. What am I talking about? I'm talking about you turned it on before FRA, full retirement age. And if you do so, they're going to take $1 in Social Security withheld for every $2 you earn. So you'll be hitting your FRA in 2022. That limit rises to $51,960 if you're becoming FRA. From there, you'll have $1 in Social Security benefits withheld for every $3 you earn.
Kevin in Springfield, you're on Winning at Life with Gregory Ricks. How can we help you, Kevin?
How you doing today?
Hey, Kevin. Good. You?
Hey, I'm doing good, sir. My kind of question for you is I'm gonna retire in a couple of years, and I'll have about the difference, the retirement coming from my company. I can take a lump sum of about $700,000, or I can take a monthly annuity kind of deal of about $3,500 a month. How do you decide which way to go with that? Because I can't figure out which way is the best way to go with that.
Well, first off, I kind of look at what is the percentage of that. When the lump sum tells you the value, so that's $700K in that case. So the other thing I'm going to look at is what, and you're at $3,500 a month, so that's $42,000 a year. So then you're kind of looking at the 700K. One of the questions I ask is that annual payment more or less than 5% of distribution on the assets. So 5% distribution on 700K is easy. That's 35,000. So you're more than that at 42,000. So if it was under 5%, it would be more a serious consideration of taking the lump sum. But you're getting neighborhood of what, 6% from that number?
Yeah, and that's
actually it is
for my wife
6%.
also.
Yeah. Now, if you died, would that check continue to your wife, the 42?
Yes, the same amount.
The same amount. Okay, that's an important
what the wife thing.
Yeah, that's an important question, and that's the way I look at it. If you're a single guy, then that's probably a different number. But when you look at retirement, you have to look at spousal continuation. I don't care any other numbers. I like that 100% payout. So we're at 6%. You know, that's pretty solid return out there for that. So as far as
that's what I'm thinking too.
And just let's compare it to market. You know, the S&P 500's averaged a little over 8% the past 21 years, but it doesn't make 8% every year. For it to actually have to reach the equivalent, you've got to be at about 6.25% going forward with a gain every year to reach the equivalent of that 8. Because that 8's high because it has to make up losses like in 2008 and like in 2018. So you get that. So 6% is a strong return. So then we shift to what is your confidence in that company to be around another 30 years or so?
Yeah, very, very high. It's a very good oil refining company. So I think it's in good shape in that regard.
Yeah, it don't look like we're going to run out of oil and they're going to go broke.
No, I don't think so. I don't care how they want to do it, but I don't think that's going to happen.
Yeah, so that's kind of the two parts to think about. And this isn't 700,000. Let's get that 700,000 so I could go manage it. No, I like the idea of that. Here's one thing. Even if we did consider it, the other part is you can't mess that money up. And first, you can't go get 42,000 off of that. You're going to be getting, probably a 4% income stream on it. So you're going to give up 2% in income out there. And from your standpoint is, I don't need somebody to mess up my 700,000. You might be better off taking the pension. Me as an advisor in getting to know you, I have to if this was a situation where that lump sum compared to the payments was say like 4.5, could we take the lump sum, and is he going to be a good steward of the money going forward? Because we don't need this. This needs to last you a long time. So this is how I think about it. And I think your 6% off of that's pretty solid, and you like the company. So that kind of answers your question.
Yes, sir, it does.
Okay.
I got another question for you. Maybe you could answer for me. So I'm going to retire. I own, let's say, a $250,000 home in Texas. I own the same $250,000 home here in Springfield, Louisiana. And from a tax standpoint, I was really trying to catch the last guy also. I don't know whether I should become a resident of Texas or stay a resident of Louisiana. Let's say if I'm bringing home, when I do Social Security, it'll probably be $90,000 to $100,000 a year between the two.
Well, from an income standpoint, we know Texas is going to be more favorable. I think Mississippi's a little more favorable than Louisiana as well. So that's probably something where you'd probably sit down with a CPA. Now, what we do in our firm is if you're working with us, we look at your 1040 and run an analysis every year. And we could look at that in income scenarios, also in where you live scenarios to kind of forward look. What's the opportunities out there? Is there some efficiencies? Do you plan to keep both houses going forward?
Yes.
Okay. Well, then they get in the...
Kind of split the time between two places.
Yeah. And wherever you're supposed to be living and paying taxes, I think you're probably supposed to have more time there. So keep that in mind in how you do stuff. But I would get a little bit of CPA advice on that, because what you don't want is somebody coming after you later. We want that difference in taxes. You owe us too. Some of these states are kind of greedy. I hear New York really chases down people that move away as well. So,
okay.
But you have options. So congrats on that. Thanks for listening to the show, Kevin.
All right. Incredible call from Kevin, because how many questions over the years have we got that's the old pension versus lump sum buyout offer?
Yeah, we were having a discussion. One of the advisors on my team and I was discussing that the other day, kind of in depth, all the things you have to consider. And it's if the percentage of income to the lump sum is over 5%, you have to have a real solid discussion about opting out of that income and taking the lump sum, especially if it's like 6.5%, like, dude, or 7%. That's a pretty good darn income. It means they lowballed you on the lump sum. Now, on the other end, you kind of say, wow, that lump sum based on the pension income is 4% of the lump sum. Well, they really stepped up to the plate wanting to buy you out of that monthly pension. So then you also have to consider the quality of the company as well. And then do you trust yourself or who you're working with is not to mess up that money if you take the lump sum, because the pension, as long as the company stays good, you can't mess that up. Hey, if you'd like some more information about 401ks, go to gregoryricks.com/401k or call my office, 504-832-9200, gregoryricks.com.
Thanks for hanging out tonight. I'll see you again. We are Winning at Life with Gregory Ricks.
Investment advisory services offered through AE Wealth Management, LLC. Winning at Life with Gregory Ricks is for informational purposes only and does not recommend the sale or purchase of any specific securities, investments, legal advice, or tax advice. Investing involves risk, including potential loss of principal. Roth conversion is a taxable event and may have several tax-related consequences. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. The information and opinions contained herein are provided by third parties and have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed. Neither AE Wealth Management nor advisors providing investment advisory services through AE Wealth Management recommend or facilitate the buying or selling of cryptocurrencies. The firm is not affiliated with the U.S. government or any governmental agency. The firm offers insurance services. We are Winning at Life with Gregory Ricks.
WRNO FM, New Orleans, an iHeart radio station. Available everywhere on our free iHeart radio app. #1 for music, radio, and